Okay, in this lesson I want to explain how a company's beta is calculated. So the example we're looking at is page 174. This is in Chapter 6. So we're given the S&P 500 returns, which is the independent or X variable, and the McDonald's returns, which is the response or Y variable. Um, in a quantitative analysis class, you would probably walk through a simple linear regression, and that's basically what we're going to have Excel do, but it's going to do it really fast. So we don't see all the behind the scenes grunt work, but that's essentially what it's doing, is trying to find the slope of this equation. Dealing with the concept of beta, if we think about the risk of a company, I want to be rewarded more for higher risk. So the higher the beta, the higher the volatility in returns, the greater degree of risk. If your company's beta is 1, that means that it moves relative to the market. That is, if the market goes up 10%, your company stock will go up 10%. If the market goes down 10%, your company stock will go down 10%. Beta of 2 would look at this way, that if the market goes up 10%, your company stock goes up 20% on average for the returns. Or if it goes down 10% for the market, your company's on historical return is down 20%. So what we're going to do to calculate the beta for S&P 500 McDonald's, I'm going to highlight this whole area here. And if I go into Insert, I'm going to go to Scatter Diagram and just click my scatter plots. We have our McDonald's right here, the plotted values, similar to what you see on page 174. Then on the different options of the charts, I'm going to go up top here. There's one with f of x that puts a function on it. So if I check that, and I go down the chart again, you'll notice that it gave me the simple linear equation. It says y equals 0.5582x minus 0.2889. That would be our intercept. Not a great R-squared, so not a great relationship between the line of best fit, but nevertheless, you can see that it matches up to our textbook where it says it has a slope of 0.56. They rounded here, so we can say our beta for McDonald's was equal to 0.56. Interpret this, it's kind of saying that if the market goes up 10%, McDonald's goes up 5.6%, or if the market goes down 10%, McDonald's returns would go down 5.6%. Looking at that return over the time period that we look at, looks like a 6-month period there. One last thing to mention here with the capital asset pricing model. This is on page 178, and this was developed to a degree by William Sharp. I'm going to try to put a video out there with an interview with William Sharp, but he won a Nobel Prize in economics for this theory, and the idea that a rate of return on a security, what we call equity, is comprised of the risk-free rate plus beta times the difference between the market return and the risk-free rate. The difference between the market return and the risk-free rate, think of a risk-free rate as a treasury bill. So like a risk-free rate in this example, 5%. It could be a treasury bill or note. But that's the premium, what people want versus the stock market versus a risk-free return. If you think of all this, the beta times the difference, that's what we'd call the market risk premium. Okay, so just kind of walk through the example they have for the example with a beta of 2. If I say, all right, equals, in this case, we have 5 plus, and we go 2 times the difference between 12 minus 5, which is the 7%. And it looks like we want the correct formula, so we'll say yes. So that's where we come up with a return of 19%. And this is saying, let's go back here a little bit, so edit undo. In terms of the rate of return investors expect, it doesn't mean that's what they're going to get, but this kind of gives us a baseline. If it was an all-equity finance company, what is their opportunity cost? What is their discount rate? Well, their investors would expect at least a 19% rate of return for the company on any type of projects it's taking on. Even if it was a 10% rate of return, it's not meeting the investor's opportunity cost for the risk. So that wraps up our brief lesson on Chapter 6 on beta and the capital asset pricing model.